JBlog, August 16th, 2009. Looking through the historical charts here, we actually have a monthly chart of the S&P 500 in the Great Depression. And this right here is 1929. The crash of 1929 had a little bounce there and then came down. A low in the market was reached in the beginning of 1932. Then it had a little run up. It went to a second low here, a bit higher low, and then it made a higher high, and then basically it went sideways until 1935. Then it had a little run up till 1937, and then came down again, and then petered off. So in this period here, there was really a lot of sideward action, except for this little piece here. But generally, the uh, the main motion was sidewards rather than up or down. Now, the big question on everybody's mind, of course, is what is going to be the shape of this particular market downturn, market crash. Here we have the fall of 2007, and we came down hard. There was a little recovery here, came down hard, a little jump up, and two more down. And ever since then, it's been green candles or white candles going up. So we've been going up for 1, 2, 3, 4, 5, 6 months. This little pullback that we saw a couple of months ago doesn't even show on the monthly chart. So from that point of view, that's just a blip. Now, as you know by now, I'm still in the bear camp on this particular one. I am not going to buy into the V-shaped bottom at this time. The thing that I'm starting to notice, that I have noticed, that's giving me a kind of an idea that once again this could be a top right here, is a technical non-confirmation of some of the technical indicators, specifically the RSI. Here we have a market. This is the New York Stock Exchange Index with all the stocks on it. Here we have a market that has basically gone flat for about 2 weeks. It's not done anything. But even though we have we've reached, even over here, we've reached very slightly higher highs. The RSI is not confirming that. The high highs have been reached right at the beginning of this, and since then it's been smaller tops. That's exactly what happened in 2007. If we look at the more short-term RSI right here, we see a more defined decline. This could be a possible sign that this market is once again running out of steam. Now, for the past weeks, a lot of what really wasn't bullish news was very much presented as bullish news. Green shoots everywhere, economy is recovering, everything is going to be fine, and we're going to go back up to where we were, and we're going to go beyond. When you start looking into the details of those statistics, then you will see that what the press is reporting as bullish really isn't that bullish. A decline of the rate of increase of unemployment doesn't necessarily mean that unemployment is over. Actually, the unemployment rate will probably continue to increase well into 2010, with more people becoming unemployed by then. And as I've covered in my last two blogs, the stock market isn't really that good a forward-looking indicator. The Looking back into the S&P 500 PE ratio seems to be much more of a forward-looking indicator, and there we see that recovery, and I've just looked through this, a recovery can really only take place once the PE ratio of the S&P 500 is improving, which it is not at this point. Now, there's nothing new that came out, but last I checked, the PE ratio of the S&P 500 was still 144, and that is amazingly high. That basically means that if you bought all the stocks, the entire S&P 500, lock, stock, and barrel, all the company, it would take you 144 years to recover your money based on current earnings. If those companies somehow manage to double their earnings, it'll still take 72 years to do the same thing. If they quadruple it, it'll take 35, 36 years. Again, that's not value. I do not see value at this point. I really do not want to own a lot. I continue being short, and I just continue adding small short positions to my portfolio, being very careful not to exceed my margins because the market can go up or down, can continue going in the direction that is irrational for much longer than many of us have liquidity for. So we do have to be careful. Doing a negative feedback trading is a dangerous thing. So as I said, I keep adding small positions. Is tomorrow the day, or usually it's Tuesday the day that the market turns lower? I'm not sure, but I'm perfectly happy to just sit in shorts right now and wait it out because I simply cannot see that this has much further to run. But I've been proven wrong many times before, and I might be wrong on this one as well. We'll just have to see. If you feel bullish about this, go ahead, throw your money in, load up the truck. It's fine with me. As for me, I'm not putting any money on the long side at this point. Mainly because of these non-confirmations, and also we have that was a non-confirmation in the the NYSE, the New York Stock Exchange Composite. Here's non-confirmation on the RSI in the S&P 500. Also the MACD seems to be rolling over. The stochastics has dipped just slightly below. We're starting to have lower highs on the OBV. So all of these things are sort of pointing to that there could be a sea change coming up. Unless the press can once again talk it up and then the bears get another week to play with, but sooner or later the bears will fail. That is my opinion, and I'm trading accordingly. So that's all I have for today, um, and I hope you have a good time in the market next week. Hope you make some money, and we'll talk again next weekend. Thank you.